Welcome, everyone. Good morning. And today we're going to be here on a very interesting session. We're going to talk a lot about crypto, forex potentially. We are here with Kieran and Patrick. Kieran, welcome you back. We did a session, I think, a few months ago on forex and data around investing, which was awesome. So we are happy to have you back and welcome.
I appreciate you having me back. Thank you. Thank you for inviting me back to do another session. It's a pleasure to be here.
Great. And I think since then, I think a few things have changed also at your professional level. So I think maybe if you want to give an introduction about yourself, about what you're doing now, that would be awesome. And then we can start talking about the crypto world. Yeah.
Of course, yeah. So for those who don't know me, my name's Kieran and I'm head of UK growth and business development at Darwinex and Darwinex Zero. So I've worked for Darwinex for some time now, coming up to 2 years. However, when we did the last stream, I think my role has changed quite significantly since then. I don't even remember when the first stream that we did together was, potentially the beginning of this year, maybe. Yeah. So at that time, I was just handling social media and copywriting and doing more of the marketing side of things for Darwinex. As time went on, I grew closer to the team, more opportunities arose, and I then stepped into the role of head of UK growth and business development. Now, what that means is I do a whole load of things, and you can't really quantify it down to just a few specific tasks, but I'm always on the hunt for good traders and good investors. Our job and mission as a company is to pair high quality trading talent with investors who've got capital that they want to diversify their portfolio with. That's a very bird's eye, 30,000 foot view into the company. I'm happy to go into more detail about that, but my job is just to, like I say, grow the business, find the best trading talent that's out there. And believe me, there is some fantastic trading talent out there, contrary to what most people think, being in an industry where a lot of people don't actually make it as a trader. But there are some great guys and girls that I've met over the past couple of years being at Darwinex.
And so how does it work? So investors, typically, are they institutional investors or they are like private wealth clients that want to like really get an exposure on more like active trading? Or
it depends, right? So we have a whole range of clients on the investor side, from small investors who've just put $500,000 into their investment account, all the way up to high net worth clients, family offices, and people from the I'm not going to call them institutional players, but more professional players. We have just released 2 days ago our hedge fund. So our hedge fund, which is called the INDX, has just gone live, which is basically a portfolio of the top 150 traders or so on our platform. So historically, how it's worked is an investor would create an account through Darwinex. They would then do their due diligence, do their research on whichever trader that they wanted to invest capital with. We do a few unique things on the side of that. So we have a proprietary risk engine that basically works akin to having a risk manager at a prop desk or investment bank, which runs 24/7 on every trader on our platform, so that an investor knows their maximum downside per month when investing into a specific strategy. But what we've realized is that a lot of investors who are kind of passive investors don't want this essential decision making. They want to be able to park their capital, let it be managed, walk away and not think about it. So we released our hedge fund, which again is taking the top 150 to 200 traders at any given time from the whole database of traders that we have at Darwinex and Darwinex Zero, and we allocate capital to that whole bunch of traders. Now, for an investor, what it does is they have a portfolio that is automatically diversified. They don't have to make the decisions of who they're going to invest in, how much they're going to invest in, or the million and one decisions that come with making an investment. And they also don't have to manage it. So, for example, if one of the traders in the portfolio begins to underperform compared to 10 different traders that we have who aren't quite in the index yet, we do have the flexibility to be able to remove a trader or reduce their allocation whilst increasing allocation to other traders. So what that means for an investor is their portfolio is consistently being managed, consistently being measured as a benchmark, and their risk is always under control. So that's kind of how it works now.
Yeah, makes sense. So it's kind of like investing in the best talent but diversifying. So as an investor, you only have one security, and then you guys do the rest of like diversifying.
Exactly. Yeah.
So, and what assets do you guys particularly trade? Is it based on forex, crypto?
So there's a whole range of assets that go through that. So we offer to clients futures trading, FX and CFD trading, crypto trading, stock and ETFs trading. So we have a various different account types for traders to come on and build their record with and attract investment. However, having said that, the index right now is very, very heavily weighted towards the CFD side of things. So the forex CFD side of things, purely based on the fact that the guys who have been cherry picked for the index and for the hedge fund, they've got a track record, a minimum of 8 months. Okay, so to even be considered, your track record has to be a minimum of 8 months. Then there's a whole load of other checks that we go through to include somebody. But what I mean by that is, for example, our cryptocurrency account. So somebody wants to come and trade crypto CFDs. That was only recently released. So nobody from that side of things would be in the index purely because their track record isn't long enough. So it's very heavily weighted to that side. But it's spread amongst different asset classes. So we have indices traders, commodities traders, FX traders, you name it, we've got it.
Okay. And how do you see, so for example, in the last few months, of course, with the volatility, futures trading has become kind of very challenging. What are the trends that you see at your level from traders? Are they shifting towards other assets or?
So, I mean, generally, right. So I analyze hundreds of traders a week, right? Because I get instant access to everybody's record. So I'm constantly looking at traders, reviewing their performance, taking a look. I mean, Patrick comes to some of the sessions that I do on a weekly basis where I go over people's strategy and, provide them with insights on it and stuff. So I'm always looking at traders. I'm always seeing how performance is. And so I notice specific patterns and specific trends. I will say without a doubt, this year has been collectively probably the worst year that I've ever seen from not just one or two traders, but collectively as a group. Specifically, the beginning of the year. Obviously, we know now it's because of tariffs, and then we've had the war heating up with Israel, Iran, Israel, Palestine, Ukraine, and Russia. So there's so many factors as to why volatility is higher than it normally is. But I think this year specifically caught a lot of people off guard. And like I say, there's traders have gone one or two ways from what I've noticed. There's traders who this has been the worst performance of their career, which is very, very common. But the other traders, there's nobody in between. The other traders have completely excelled. And maybe it's due to the way they trade. For example, trading breakouts. Breakout strategies have been absolutely on fire, right? Because the market moves. Whereas mean reverters have really struggled, or at least what I've noticed is mean reversion traders have really struggled over the past few months. And that's just collectively as a group. So,
yeah, that makes sense. And what about like in the crypto space? You said that you recently launched kind of like a fund there. How do you see like this bull market that we're seeing? Like traders, are they moving towards that asset or?
It's difficult to say. So I don't usually check what asset a trader is trading to look at their strategy, right? I'll look at their strategy and then kind of what they're trading is indifferent to me. So what I've noticed with a lot of the crypto traders who I have seen is they use the account to get long. So I'm not saying this is for everybody, because of course there's fantastic traders coming through all the time, but I think the difference in approach from the traders on the CFD level compared to the difference on the crypto level, it's kind of like these guys are used to a bull market and therefore they're using their Darwinex accounts to try and capture more of that bull run. So I guess we won't really know the quality of these traders and any specific trends until the market pulls back or goes through a bear cycle. We won't know the quality of these traders, which is, a broader issue anyway, is when you're evaluating traders to potentially allocate capital to them, regardless of whether it's 10,000 or 10 million, you need to know how that trader performs during different market cycles, right? Regardless if you've got a track record, that's great, but I want to know how you perform during this period of time. During this period of time, when there's low interest rates, high interest rates, negative interest rates, Trump in power, Biden in power, all of these different contingencies and variables, I want to know that you can perform through it all. So again, I think it's a little bit early to say if there's any trends or patterns that I've noticed in the crypto guys, because like I say, a lot of them are crypto bulls and they're coming in, steaming in, heavily long Bitcoin, which I completely respect. I actually got into financial markets through crypto back in 2016. So I have a lot of love for crypto as an industry. And I've been around it for a long, long time. So
it's great. So your background is in forex, right? How do you look at the crypto market, and what kind of data points do you use to kind of evaluate the crypto space? Because then we can talk about some of the things that we've done at our level and see how they can relate to what you guys do.
So this is more of a personal approach. So like I say, my introduction to financial markets was through crypto. So that was my first, before I started trading, before I learned how to buy and sell, a CFD, I was introduced to crypto by my dad. He introduced me to Bitcoin. We ended up, putting a bit of money into Bitcoin, Ethereum, XRP, Litecoin, all of these different coins that were available on Coinbase at the time, because in the UK, we were quite restricted with the exchanges that we had. And then it was only a couple of years after that, or a year or two after that, that I got into trading, which, I went into FX trading. So I kind of had a separate vision of both crypto and FX, because I was I wouldn't say an early adopter, but I was active in crypto before it kind of got mainstream. So when I revisited it back in 2020, I had a lot more smarts about how to invest, how to trade, like, market cap, I was just buying Bitcoin because I saw it was red on the day, and I wanted to take advantage of it, right, back in 2016. But I actually went full-time in crypto for 2 years. Through 2021 and 2022, I pretty much was trading and just working on crypto projects full-time. So I went on to various DeFi projects as an advisor. I did a lot of DeFi farming. If anyone who's watching was involved in the space back in 2021 or during the pancake swap era, I was around during then. So I had a lot to do with like DeFi projects and working with various people. I had a lot of highs, a lot of lows. And these days I don't have too much to do with crypto. I see it as kind of, I'm torn 50-50, right? Because I'm part of the people who believed in it from kind of the early days, where we go, right, it's a financial revolution, it's this, that, or the other. But these days I'm a little bit more on the side of the fence, where we go, it's fantastic technology. Like, I think it's absolutely brilliant, but it's still a speculative asset. And how long it stays and remains a speculative asset, I don't know. Will it hit 1 million? It's designed to. Will it do it in my lifetime? I just don't know. So I love talking about crypto, because I think everybody has their own unique opinions of it. But like I say, I lived and breathed it for 2 years, made a lot of money, lost a lot of money. And yeah, so I've seen both sides of the coin.
Yeah, so I think
figuratively.
One interesting trend, and the reason why we are approaching this space, is that if we look at this chart, you see the growth of the open interest on the crypto options, especially on Bitcoin. So I think it's like starting to get, we're still at the beginning. I think it's still not obviously as high as what we see on the indices side. But I think it's very important, as also for retail traders, to start looking at this kind of data, because it could bring a lot of value if you understand how this volume grows. So you see here, from 2022, we went from about 5 billion in open interest to about 35 billion in 2025. So I think the derivatives market is growing there. Of course, we are seeing a lot of assets going into the ETFs. So I think it's an interesting trend to monitor, and that's why we kind of like went into that space to understand if we can bring value to the crypto space with our quant models as well.
I think the volumes and open interest is a really interesting one, right? And it goes back to my idea of it being right now a speculative asset. And the reason I say that is because if we take a look at the stock market and we look at a company, right? We build the valuation of the company. We can look at the earnings reports. We know what they're building. We know all this information about a company, so you can kind of justify the value. And before any crypto heads, call me out and hate on me for saying this, Bitcoin generally has no intrinsic value to the everyday person right now. because they don't have the infrastructure, and they don't have the ability to go out and purchase it, spend it, and understand it. Kind of like if you rewind 20 years and go, oh, we're going to flood the market with electric cars. People would go, huh? I haven't got an electric. How am I going to charge it? There's just no infrastructure. It's really difficult to kind of give value to something where the world isn't ready for it. And I think Bitcoin is still stuck in that. And then when we look at the open interest and the volume and we go, does that justify the use case for it right now? Probably not. And therefore, that's why I see it more as a speculative asset. By saying that, I don't think it's just going to tank. I'm not saying that at all. But I genuinely think at this point, you're betting on something that hasn't necessarily proved itself as an asset yet. And again, before anybody hails me a Bitcoin hater, I'm not at all. I love the asset. I think the technology is absolutely fantastic. And if the world was to adopt Bitcoin as what it was used for or what it was designed for, I think the world would be a better place, right? I sit on that side of the fence, but I'm also a realist when it comes to markets. And I don't think it quite has, same as like Nvidia. Does it have the valuation, or does it justify the valuation that it has? Does Tesla? Probably not. But these markets keep going up. Why? Because they're speculative assets, but there is utility at the same time. So crypto is a really interesting one because the lack of regulation at the moment allows it to become a place for not very nice people to gather and take advantage of people who, don't quite have the knowledge or the know-how to spot a charlatan, spot a scam. And, I don't know if you guys saw a couple of days ago, was it yesterday? There was a stock that listed on the NASDAQ, and it basically rug pulled and had a 99.99% down day yesterday. Was it PHH, was it, I think? And, that's an everyday occurrence in crypto, multiple times a day, hundreds of times a day. And there's just that many people that get hurt. So, I'll stop rambling now, but that's my thoughts on this kind of thing.
Yeah, and I think that what you said with the scams and the volatility is very true. So that's why it's important that people that are new to the market, they focus on the more stable coins.
100%.
Rather than just waiting for the home run, just focus on building a strategy. So it's important to be consistent rather than waiting for a lottery ticket to happen, because that can 100%. Be very dangerous.
Yeah, 100%.
All right. I don't know, Patrick, if there's anything from your side that you want to add.
Yeah, so personally, I like more the trading perspective. So you was giving a good point, so that a group of traders taking some losses. My question is for you, Kieran. Why do you think with the volatility in the beginning of the year, people was not adapting to this? So reduce the risk or taking a break from the trade. What was in your mind when you were seeing this, so that maybe really good trader in the past having so much lag to adapt on the volatility? What was on your mind the biggest mistake what they do?
I don't necessarily think there's a mistake, but naturally as humans, we're quite slow to respond to things, right? And especially when there's a bit of ego involved, it becomes very difficult to adapt and to change. Now, when it's like a market condition changing, usually you don't know until it's too late. So unless you're, somebody like Michael Burry, who's thinking that there's going to be a market change months in advance or years in advance, there's no way that next week the conditions are going to change. And so you kind of don't know it's happened until it's happened. And you go, I've had a really tough, period over the past 2 or 3 months. My trading performance has dipped significantly to before that. So maybe something's changed. And then at that point, you look back retrospectively and you go, well, this quarter has been really poor, but I've been trading really well up until that point. And that's when you kind of the damage is kind of already done short term, where you've seen the dip in performance, and then you start to see them. That's when they make a change. That's when they start adapting. Usually it's very rare that you'll get a trader who, and rightly so, will make a decision based on one trade, one day, 1 week, maybe even a month. Some of the best traders that I know and talk to, their decision making will occur over weeks or months of analyzing something, because we all know with trading you're never going to win every position. And what that means is you can go through a poor period where it's just your strategy underperforming for that period, but no other reason than the market just wanted to punish you. But it doesn't mean that the market has changed. Broader market cycles and broader market changes, of course, take a little bit longer to come into play. So it's like a fine line where you go, is this just short-term underperformance by my strategy, or has the market changed? Like, has the market conditions changed? With the caveat of, let's say the Fed have a surprise interest rate hike of 50 points, right? Then, of course, you go straight away, well, there's a catalyst now for the conditions to change, because everybody is looking at the market and viewing the market in a different way, to what they was an hour ago, let's say. So that's like an instant change. But when it's something like Trump talking about tariffs, and then he backpedals and then he puts it out there again, it's like this extended period of time where things are changing and investment behavior changes. So there was nothing that kind of I could say, oh yeah, everybody was doing this and they got, they lost every trade. There's nothing like that. The only thing is, with higher volatility, of course, traders' win rate generally takes a dive. But other than that, there's nothing really. There's no kind of patterns that you can say everybody goes through this.
But that's a really good point what you say. So if you remind on this, so you were saying basically, hey, if the volatility kicks in, if the VIX is going much higher, so take care of this, because there's a high probability that you're becoming on the losing side because of the volatility. So that's a really good point, and I like this. And when we be on your strategy sessions, what I always like, you're giving really good points and you're looking into every strategy. So, but my question is for you, for the people here in the course, so on live session, what is one thing what you're seeing very often, and there's some pattern from things what traders doing really well, and things what traders doing not so good?
Okay, so that is a fantastic question, but it leads to such a broad response, right? And I know I'll probably sound like a broken record to you, because you've been in the sessions before. You know a lot of the things that I talk about, but generally, I think traders focus too much on one variable. So, and this is a general rule of thumb, somebody might learn how to read a specific pattern on a chart, and that then becomes their strategy. That becomes their identity as a trader, whether it's trading a key level, a moving average cross, whatever it may be. And they go, if I see this pattern on this chart, I'm going to execute, and then I'm going to manage it in this way. Meanwhile, they ignore every other variable that you can, look for when you're trading. And, there's just an unlimited amount of variables that you can look at and analyze as a trader. So the biggest thing that I kind of try and get across to people when I'm talking about their strategy and about refining it and making it better is take a step back from what you currently do, which is usually trading a chart, and take a look at some of the things based on your performance. So a couple of the key variables and the key metrics that I love to talk about and love to analyze for people are variables such as the assets that they trade and their expected value on those assets, or the sessions that they trade, or the days of the week. There's some really, really interesting nuances with things like days of the week, right? So we have a trader with a 10-year long track record, and over that 10 years, on Mondays, he's down 8%. Okay, so over a 10-year period, he's down 8% on a Monday. If you look at his Thursday, he's up 220%. So there's a clear discrepancy there. And it's not just something that you would look at and go, oh, well, it is what it is. Don't worry about it. You go, this is a decade worth of performance, and there is a clear differential in expected value on a Monday compared to a Friday. Okay, and now if we take that one step further, you then look at your own assets, look at the assets that you trade. Let's say I trade dollar yen, euro yen. I trade all the yens, I trade all the major pairs, I trade crypto. Take a look at individual assets and actually what's your expected value on that given asset, because you might find that you're trading the same pattern on dollar yen that you're trading on the NASDAQ, but actually you have a much higher expected value on the NASDAQ than you do on the dollar yen. So does it make sense to risk the same per trade on each asset on each day of the week when your expected value is so different? And I'm not condoning changing your risk too much and going from trading 1% to 10%, of course. But I always talk about, and this goes for beginner traders, intermediate traders, advanced, taking a look at implementing a risk barometer where we go, the baseline is 1. We work our expected value based on multiple variables outside of the chart. When those variables align, you slide your risk up the barometer. So instead of being at a 1, you might be at a 1.5. which might equate to 1% risk, 1.5% risk. It might be 0.5 to 0.75. Who knows? Completely down to you. But then when your expected value is lower, you slide your risk down the barometer. So let's say I have an asset that, I have a 30% win rate with a 1-to-1. We'll keep the payoff for each trade at a 1-to-1, just to keep things simple. Let's say on Euro Yen, I have a 30% win rate at a 1-to-1 risk to reward. And then on dollar yen, I have a 60% strike rate with a 1-to-1 risk to reward. You would look at that and you would go, well, clearly something's different because I'm winning twice the amount of positions, same payoff ratio, therefore those trades are better. Now, if we look at the Monday and Thursday example, I go, well, there's an asset that I continuously lose on because I have a 1-to-1 risk to reward and a negative strike rate, or a low strike rate, sorry. And I'm trading on a day that historically I don't perform well on. Compare that to an asset that you perform really well on. Let's say gold, and you've made X amount of percent. You've got a win rate of 70 with a payoff ratio of 2-to-1, and you're trading that on a Thursday. Does it make sense to risk the same amount per trade on the two different assets on the 2 different days? Of course it doesn't, at least not in my opinion anyway. I always talk about poker players. And whilst there's, it's worlds apart, trading and poker, there are some very, very key similarities. And I always say, a poker player will never bet based on the fact that they go, oh, I've been taught to risk $100 on every hand that I have to play. A poker player will bet based on the probability of their hand playing out. Okay? If they have a better hand, they'll put more money down. If they have a worse hand, of course, what do you think they're going to do? They're going to fold and say, this one's not for me. I'm happy to take a loss at this point. So I try and get traders to adopt that same mindset and approach when looking at their expected value. Bit of a long answer, but I hope I answered your question well, Patrick.
Yes, 100%. I love this so much. Because there's so much value in, because what I think, so many retail traders, what I know, and also in the communities, and I think this will be matched with Darwinex, also many traders coming from the prop world. Yeah, so like they come from prop firms that call this educator, but they trade with prop accounts. They're doing challenges. And I think one mistake what the people doing is, every time when they blow some challenges or they lose something, they delete all the data. Not all, but I will say 80%. If they're losing the challenge, they delete the data. So the trade what they executed. And every time when you speak, Kieran, I remember you say always, hey, I need a minimum of six months track record or 1 year to make a really good decision. So how we can improve. And that's one of the points. So if you delete all your data, and maybe you're taking losses, but in all your data, there's so much value, and you should take advantage of this. And that's the point where mostly will lose.
Yeah, and I think that there's a massive, massive problem with the funding industry, right? Like me as a trader, I've used funding companies for the past 4 years, and I've made money, so I appreciate it as a trader. However, there's a big caveat to that, right? Is that it enforces an artificial view and an artificial condition for traders, right? So if I'm purchasing accounts, I then have drawdown limits. I have rules that I can't do, so I can't trade through news. I've actually had on a funded account before profit taken away from me because I traded through a news event. However, my part of my edge was entering off of news, like key levels off of news. I know the expected value of that, but I was punished because of my behavior. So there's this big artificial environment, and traders get used to that, right? And they get, again, going back to comfortability, they get comfortable in that kind of if I lose this account, it doesn't matter because I can just buy a new one, right? So the prop game or the funding game can reward traders who aren't profitable, and the trader can still be net positive. So the best example I give for this is imagine you purchase 10 challenges, all at 100K, and let's say they cost, for argument's sake, £500, dollars, euros, whatever your currency is. Now you're down £5,000, dollars, euros, because you bought 10 challenges and you've got $1 million in funding. Now, let's say you blew 8 of those accounts, okay? So you're down $80,000 on those accounts because you've got a $10,000 drawdown limit on each 100,000. Blown 8, down 80,000. Now, if you then pass the last remaining 2 accounts, let's say you have to make 10% on the initial phase 1, and then you have to make 5% additional on the phase 2. So that's 30%, okay? So you're down 80 grand. So you're at 920,000. You make 30% of that. My maths is pretty bad, but let's say you've just made 30 grand. So you're back up at 950,000. Okay. So then let's say you take a 10 grand payout. So you make 10,000, you take a 10 grand payout. Now you're actually up 5 grand as the trader because you put 5K in, you've took 10 grand out. So you paid yourself back the 5K and you've made 5 grand profit, right? The firm, well, Let's not talk about the firms because we don't know, but the simulated equity curve, right? You're actually down like 50K or 40K because you started at $1 million, you lost 80 grand, and then you might have made 50. Now you've taken a payout and you basically doubled your investment, 5 in, 10 out. But actually as a trader, you're massively down for that same period of time. But because there's an artificial environment that's been created where with these drawdown limits and the account resets, you don't even realize that you're a losing trader because you don't track it, right? You don't have access to the data. So this is what frustrates me big time. And I won't name drop because I don't want to get sued, but there's a lot of guys online who I see have success with prop firms. They post certificates, they give it, Billy Big Boy online. I'm the best trader since sliced bread. I'll look at their account with Darwinex and they might, they've cancelled it because they blew it up. And I'm like, well, the reason that they did this is because they don't know how bad of a trader they actually are, because they've only been used to this simulated artificial environment. When they come into the big bad world of, well, when you go into 10% drawdown, there's no reset button. You've got to work your way out of it. They can't handle it and they don't know how to do it. So again, rant over, but it's a really, really important point based on what you said about funding companies.
Yes, and this is also something, Fabio, where we can jump in and help the people. So with our levels and with our models, so we can give them a little bit better edge to read the market. And I will switch this now to you, Fabio. How people can use our tools to get a better edge. So we were speaking about some trader. We have now the picture. Like Kieran was saying, maybe you be a prop trader, and exactly this what Kieran is saying. You don't know that you may be a bad trader because of all the rules and all the stuff, how everything is good, but how we can deliver a better edge to the people from you.
Yeah, absolutely. And then we can go maybe show some of the things that we've done. But I want to give an example on NVIDIA, right? So yesterday, NVIDIA reached, like Kieran said, 4 trillion market cap, right? So how can you use kind of data to potentially understand where the big money is going, right? So if we look at 1 second on NVIDIA, we can see that we now have a scoring system. This is our proprietary model. And the scoring system is telling me that at the option level, we are basically very bullish. 5 is the maximum, 0 is the minimum. So it goes from 0 to 5. So we are very bullish on the option side. We are very bullish on the momentum side, so the price action. and we are very low on volatility, right? So if we look at the history of this, 2 months ago, the picture was a little bit different. So we went from a very bearish option kind of sentiment to a very bullish in just a few days. This was April 24th. Since then, basically, of course, this is history. NVIDIA also grew because of the AI. So there's been a lot of catalyst in the market. But essentially, if we look at data, we can look at how the positioning is changing, and then how can that reflect with the price action. So we saw like a 56% rally in just the last 2 months on NVIDIA, right? But we can use the same metric at any given level. So if we go back to the crypto section, we can look, for example, at Bitcoin, right? So with Bitcoin, what we do is we look at the derivatives market, which is, of course, growing. So we have different tickers. We can use Deribit, we can use Binance, we can use OKX. And then we can see basically like how the sentiment in the market at the momentum side, at the volatility side is playing out. So we see a very similar scenario, right? We're in a very bullish environment coming from the option market. We're in a very bullish environment coming from the price action, and the volatility is pretty low. So like we don't see a seeking of kind of like downside protection from the volatility standpoint. And then here, another thing that is also very important is we look at the quant models, is crypto typically behaves like an early stage tech company. So it's basically very, very correlated to the macro environment. So if we look at our risk on, risk off, which is telling us, are we in a risk on scenario for crypto or are we in a risk off scenario for crypto? We can see that we were kind of like almost at the threshold level a couple of days ago, and now we're back in a risk on scenario. So the kind of like looking at that to kind of confirm your idea on an asset can be very, very important. And if we look at the direction, we went from a neutral a few days ago. Now we are kind of back in kind of like a bullish directional cycle from the model. So this is kind of like how you can quickly understand. And of course, Kieran, let me know if you have questions on how traders can approach this. But it's really using data to potentially get an edge. And then, of course, on top of that, you can kind of use the levels directly on the chart. So if you see here, core resistance had like a massive reaction area at this level here, and then we break through the area. So this can be basically supporting tools for traders, depending on if you are a day trader, position trader, or swing trader as well. And let me know, Patrick, if I miss anything.
No, that's perfect. And so to be really honest, Kieran, I've been now on Darwinex side since 2.5 years, but it took me 2 years to figure out how everything is working. So I'll be really honest. So I see how many traders are saying like, hey, I'm a really good trader, and then you join Darwinex and you say, what the fuck? So what's going on here? So and then it takes 2 years to figure out how you can become more successful with Darwinex, but it's worth to spend the time. And one thing I remember when I was talking to Juan, and I think also you're saying this also, what people always miss is trading is not a sprint, it's a marathon. Mm-hmm. And people see only the small picture for this week, this day, but they never see, hey, how I can become a better trader in the next 5 years, in the next 10 years, what tools I need, what partner I need to become a better trader. And this is the long vision picture. And I think, and this is why I was pick you for the call again, because when we speaking about Bitcoin, I know exactly you can trade with Bitcoin on Darwinex or Darwinex Zero. I will not pitch Darwinex Zero. Everyone should take a look into this. Of course, no advertising. But if you want to grow as a trader, in the next 10 years, massive, and you won't be going on your tipping point in the next 3 years, that's the right place to go. With our tools on your hand and with the experience on Darwinex, you have an amazing chance to grow. And remember, Kieran is every single week there. It helps you with your strategy, and you can have feedback. And also, we have also sessions here on MenthorQ where we're helping you as trader to grow and understand how everything is working. And if we merge all this together, Kieran, the bigger picture is always the best view. What you was learning from Juan, and also what is in your mind about short-term picture and long-term picture on trading, because you see this every single day.
Yeah, I mean, there's quite a lot to unpack there. So the first thing, which I feel like we have to address, is the being able to understand it, right? So I'm not oblivious. Darwinex is quite a complex platform. It's quite a complex structure, and it can take some time to fully understand it. That's down to us as a company and how we've positioned ourselves and how we've got the message across. It's historically not been the best, right? In terms of, we've had a problem being able to explain what we do. And it's been my job over the past few months / year to try and really get that message into an elevator pitch. So if I was in a lift with somebody for 30 seconds, I could tell them categorically who Darwinex is and what we do. But to be honest, it's very, very difficult to do so. The only thing I tell people is just trade and, learn over time. Just trade as best you can. And again, that's why I don't like these artificial trading environments, because people come in expecting the same. And I just say, just trade as well as you can for as long a period of time as you can. But again, it's really down to us as a company. We should, and we are looking to position ourselves better so that people understand us more from the outset. Hence the index. It's a lot easier to pitch us as a hedge fund as opposed to saying to an investor, you have to come on and choose your Darwin and choose all this and do all that. It's like, well, what's a Darwin to begin with? I don't know. Okay, well, just invest into the hedge fund. You'll understand that. So that's what we're looking to do right now. What was some of the other points that you raised? What were they again?
Yeah, so the view from the people, the short-term view. So hey, I want my payout next month, and not getting the bigger picture what you can really have. So think about most people are trained. I need 80% profit split. I get a payout from 5,000 if I'm doing well. That's impossible in the big world. So you have to work for this, and it needs a longer time. But the reward what you get at the end of the years is much, much higher. And this is what the people misunderstood.
Yeah, I think in any business, right, you're never going to please everybody. You're never going to have a business where every single person is your client or your friend or whatever. Look at Apple, historically one of the biggest companies to have ever existed. You still have people on the side of the fence where they go, I hate Apple products. I feel like a lot of people say it just to say it because it's fashionable. I hate Apple. I will never use them. I'm happy with my Samsung. So no matter how big or good you get, people will always, you won't align with what people want. Now, bringing that to Darwinex is, we, like Apple, have a big split and a big divide, right? Where we have a load of traders that go, do you know what? I don't really care. I see the positive payoff, if only in being able to learn and develop and become a better trader. But if they say, for example, with Darwinex Zero, if they're paying 38 euros a month and they take a payout per year of 1,000 euros or $1,000, they're still massively up on the year. They've still 2x'd their initial investment. But people look at that and they go, oh, it's not enough, right? It's not enough. And that brings us to the people on the other side of the fence where, again, I just don't think our product and the fund management industry is actually aligned with a lot of these traders' goals and wants and needs. The funny question, or the funny thing that I always say to these guys is when they say 15% is too low, why not pay me 80%? Something along those lines. I always say to these traders, like, think about how many firms have gone under from paying 80%, right? That tells you a lot about their business model, in the fact that it's a predatory business model. They want you to fail. Again, I've used them. I enjoy using them as a trader. However, if you don't know how to trade long term, you're probably just going to keep paying into the prop firm, and they're just going to keep taking your money, and you'll never get a payout. The statistics show that. Ask yourself why they pay 80%. If you went up to an investor in the street, you know, or a serious professional investor, and you said, let me manage $1 million of your capital, you take all the risk, and I'll give you 10% or 20% of the returns. That investor is going to laugh you out of the room, right? Without doubt. An investor will never take such a small piece of the pie. So that's the first thing. But secondly, I kind of say it a little bit tongue in cheek, but I'm like, show me your payouts from these prop firms. If Darwinex is no good for you, show me the payouts that you've got from these prop firms, right? Because if you've made 10 grand this month from FTMO or Funding Pips, whoever it may be, Apex, like, fair play, keep doing what you're doing. Don't disturb it, you know. But the likelihood is the people who are, you know, in our Discord or on Twitter saying 15% is not enough, the likelihood is they've never taken a payout in their life, and that's just the top and bottom of it. So, you know, I kind of laugh, and I'm like, well, you haven't grasped what it is to be a trader and what it is to scale as a trader. You're just so focused on this. You're caught chasing the goal, right? The goal is get that FTMO account. When I get my FTMO account, I will be happy because I will be able to earn money. Okay, whatever. Like, you do you. That's absolutely fine. But just don't get caught in the loop of, you know, trying to do that same thing, failing, and thinking that doing it again is going to fix all your issues.
Yeah. And you know what? I think now we're rolling out now the final question, because the stage is now perfect. Fabio, if I remember, you was working also with big institutionals. You was delivering data, correct?
Yeah.
All right. So, and now guys, if you be now live, that's a really interesting question where you can learn so much from. And we are now on minute 47. And now this is the time where you can taking golden nuggets where you should take your notes. All right. So I was listening to Juan last Christmas, in the last Christmas session. He was saying, basically, it's so hard to pitch investor retail traders because they laugh about retail traders. We have to find out and prove that retail traders are really good, that there are some retail traders who are doing a nice job. My question for you guys, for you, Kieran, and for you, Fabio, and Fabio, you first, maybe. So what do you think? Why institutional thinking that retail trader not so good? And what retail trader missing that they can become maybe not on the same level, but they have a really good chance?
Yeah, that's an awesome question, Patrick. So I think if we look at the last 5 years, right, when we started, of course, MenthorQ, I think that there's a couple of problems. One, first is that retail have less capital than institutions, and they are not willing to wait to generate capital from a maybe 7% return, which is the stock market return. So they are looking, or they are seeking for higher returns, and that's why the option market went so crazy over the past 5 years, because it proved that with the small capital you could actually make a lot of money, and you could actually have like 40% return. So during 2020, everybody that didn't know how to trade was making a 50% return, right? So as a result, as a trader, you think you are the best trader in the world, but then the next year proves that everybody lost money. So I have so many friends that made a 50% return on 2020 and lost a 70% on 2021, right? Because they don't know how to manage risk. So everybody thinks about making money, but the really key part is how can I actually make money while managing my risk? So that's problem number one. And then, of course, retail traders historically did not have access to the same type of information than institutions have. So I think now the data is more democratized. But like if you just look at, I worked for Bloomberg for about 11 years, a Bloomberg terminal cost about 30 grand per seat, right? So as a retail trader, this is impossible to have, right? So the institutions obviously have access to a lot of data, or the professional player have access to a lot of data. But I think the gap is kind of coming to an end, and that's also why we want to provide this kind of level, because then as a retail trader, you need to find an edge, and you also need to stop using the strategy that everybody's using. So if you are like following somebody on YouTube that is using the RSI, for example, there's no statistical advantage in doing that because everybody's looking at the same thing. So as a retail trader, I think it's very important that you start really thinking on how you can leverage the technology that we have today, which we didn't have 5 years ago, at your advantage. I don't know if that makes sense.
Yes, makes absolutely sense. Kieran, what do you think?
I think it's very dependent on, like, as a general rule of thumb, yes, retail traders are very difficult to pitch to an investor or to even gain investment just because there's so many people who can't trade. However, there are instances where, you know, let's say a trader's been tracking their performance for the past 2-3 years, right? And they approach a prop desk, like a legitimate prop desk, or a hedge fund or investment bank, whoever it may be. I think at that point, that retail trader will be taken seriously, at least to a degree, you know, and they may take that trader on for a sim period and then potentially give them capital and stuff. But it's such a niche situation that doesn't happen, and like not a lot of traders will put themselves in that position because they don't know enough about the industry. They might be a great trader, but they don't know enough how to scale. So people don't know how to network with investors. You know, that's number one. Like, I've always found that I've done a lot with investors over the past few years. Like, I network with a lot of investors, and I absolutely love it. It's completely changed me as a person. Like, a couple of years ago, I was quite not reclusive. What's the word? What's it called? I was a bit of an introvert, right? So I didn't like pushing my comfort zone in terms of people or talking to people. Whereas now I love jumping on calls with investors, with CEOs, people like this, because it pushes me outside of my comfort zone. But I've learned to talk to these sorts of people, right? I've learned what they want. I've learned what they need. I know how to fulfill that need, even if it's not myself, right? If somebody said to me, I need a trading strategy that does X, Y, Z with X performance over X period, I'm like, okay, well, I can't fulfill that, but I know somebody who can. And I think that's a skill that you learn. So the average retail trader doesn't have that exposure and doesn't have that knowledge, and therefore will approach an investor and say, hey, I trade, can I have some money? And the investor's going to be like, what reason have you given to me to want to invest into you? The opposite, you know, if an investor sees a business, a trader, whatever it may be, who's consistently generating a positive return whilst being, like, you know, low risk to a degree, an investor's going to throw money at you. I don't care what the situation is. That's just the way it is. But like I say, you have to put yourself in a position to be able to talk to investors, for one, you know, and prove your talent as a trader. I don't subscribe to the fact that it's so difficult, because I've done it quite a few times. I've raised capital myself and traded it myself through various avenues, and I've done it for other people. So I don't subscribe to it's difficult, but I think you have to be a certain type of person, and you have to have the accreditation and the knowledge to back it up. Otherwise, it's then difficult. So that's probably a pretty weak answer, because I've said yes and no. So I apologize for that. But like I said, I just think it depends on the actual individual.
No, I think there's a really great value in, because I'm working also with investors here, like what you did the last few years, and I think where we all be agree, and it's all about the time. So we have to spend time on to developing our CV. So our track record, verified track record, is our CV. And we need, I personally think about this, we need a minimum of 3 to 5 years to have a really great track record what we can present. And that's number one. So how many people on the retailer space can say, okay, I have a valid track record about the last 5 years, and they are comfortable enough to get out with this. And then what Fabio, what you were saying is the data, the information. And with all the HI, what comes out in the future and what we've done already, I highly believe we can come to some area where we can compete as retail traders with institutional traders. But then the next point is the experience and the partners. So which partners we can really trust? Then we come back also to Darwinex. So on Darwinex, you have an open door. You can prove your talent for a lower cost. You can build your track record. Everything is fine. They have the connection. Then to become successful on Darwinex, you need an edge. You need a really good trading edge. And how you can build your trading edge? Maybe you can come to MenthorQ, you build your edge based on options data, based on real data. And when the last time we were talking about this, Kieran, maybe you remember we was talking about how important our data is for us. The probability that this setup will be working. You remember?
Yeah, I remember.
So basically, all the data, all the statistics, that's something what we need. We need to partner, we need statistics, we need data, and then we need also all the news. We need, hey, what is this meaning and how we can interpret this and all this stuff. And if we connect all this together, I think you have a really good chance to get in the stage of the big players.
Yeah, I mean, like I said earlier, right? There's 1,000,001 different variables that any trader should be observing, analyzing, reviewing on a daily, weekly, monthly, yearly basis, right? Too many people get sucked into a chart. They see trading is a chart, and that's because it's the most instantaneous feedback of the market, right? The chart is consistently updating 24 hours a day, right? So there's constantly a new price, there's a new candle, there's a new this. So people see the market as a chart. Whereas what you're talking about here is taking a look at every single variable that's going to help you succeed as a trader and paying a little bit of focus on that. How do I get the best infrastructure? How do I get the most capital? How do I build the best edge? Like things outside of the chart, because I think too many people will get sucked in and just bash their head against a wall, trying new technical patterns and stuff, whilst ignoring all of this other stuff. And you might have the best pattern in the world on a chart, but if you've got bad brokers, if you've got no capital, if you've got any of these other variables aren't fulfilled, then you're still never going to make money. So, yeah.
Yeah, I think this was a great ending. What do you think, Tom?
It was awesome. Yeah, I love having you here, Kieran, because you bring a very great perspective from the experience and the industry, especially because, of course, you see a lot of traders and you speak to a lot of traders every week. So I think it's very interesting to understand the overall trend and how people can leverage the information available to become more successful, because at the end of the day, the goal is really to grow as traders. So I really thank you for being here, and thank you, Patrick, for organizing this. For those who are viewing us, there's going to be a lot of new things that we're going to do next week. So to stay up to date, just join us, join our mailing list, because we're going to have some new sessions available for everyone. So if you want to be able to take part, and then we can talk more about them tomorrow, Patrick, in our live. But if you want to be able to take part, just join us and create a free account, join our newsletter, and we stay informed for what's coming next week. And thank you very much, Kieran, for being here with us today.
Thank you for hosting me. It's been a pleasure as always.
Have a good day.
Yeah, also, Kieran, it's a pleasure that you be here, Kieran. I always enjoy this. If I'm listening to you and also if I'm talking to you, and yeah, thank you for all what you're doing and what you're doing in the future.
I appreciate that, dude, massively. Thank you very much.
Thank you, guys. Have a great
Have a
day.
good one.
Thank you, guys.
Bye bye.